Hey there, this is Arthur Hill, Chief Technical Strategist here at TrendInvestorPro.com. It is Wednesday, February 24th, and you are tuned into our YouTube channel. Thank you very much for stopping by. If you like this video, please give us a thumbs up and consider subscribing. So today we're going to talk about moving averages, the 50-day and the 200-day moving average. And it's important that you understand what these moving averages are for because they need to be used differently. The 200-day should be used for trend following, trend signals. The 50-day should be used to identify a potential mean reversion setup, a pullback within an uptrend. So I'm going to test the 200-day going back 20 years for SPY and the 50-day for that matter. And then we're going to look at some mean reversion setups in SPY and some other ETFs. Let's hit the charts. So when we're using moving averages, it's important that we use them in the correct manner. And what I mean by that is if you're using a 200-day moving average, that is a long moving average covering around 9 months. And that's more in the trend following type category when you're looking for crossovers. But if you're using a short moving average, like a 20-day or a 50-day, then that's in the mean reversion category. And what does that mean? Well, that means breaks below the 50-day when you're above the 200-day are more opportunities than threats. So let's look at this in action. I've got a chart here and it's SPY, and I'm going to back test across above the 200-day and above the 50-day over the last 20 plus years, back to 2000. So I've got Amy Broker here and I've got it set, and I'm just going to quickly run that back test. And we can see down at the bottom here that we have a compound annual return of 5.75% over 20 years, 20 plus years. That includes dividends, maximum drawdown of 24%, and you had 22 winners and 52 losers. And this is kind of the way it works with moving average crossover strategies. This is a trend following strategy, and you're often going to have more losers than you are winners. So here, and it's typical, you're going to have 29 here, 29%. So you have 30 to 40% winners and you have 60 to 70% losers. But of course, a trend following strategy makes money in the end because the gain from those winners outpaces the losses from those losers. And so I'm going to look at the trades here on the chart with the green and the red arrows. And there you can see there are going to be lots of whipsaws with any moving average strategy, even with a 200-day. So we had whipsaws there in February, March, but then we had a cross that lasted in May. And I can go back and we can look at some of these other signals. So there you can see we got a whipsaw in May 2019. And we had a little whipsaw there at the beginning when this bull run started in the early part of 2019. But the point is here that the 200-day is used for a crossover to identify a trend reversal. In other words, the start of a trend. Now, I know a way that we can reduce these whipsaws and still get a pretty decent return and capture the return of a 200-day, and that's if we just use a 5-period moving average for the crossover. In other words, wait for the 5-period moving average instead of the close to cross above or below the 200-day. And let's see how that works out. So I just ran that back test, and you can see that the compound annual return is higher, above 6%, 6.62%. Your drawdown was better, 21%, and you got up to 40% winners and 60% losers. So just by smoothing your close with a 5-day moving average, you improve performance. And if we look at the signals here, we can see we didn't get the whipsaws there in early 2019. We didn't get the whipsaw in May because the 5-day moving average smoothed that out. And we didn't get the whipsaws in February, March. So you're going to get a lot fewer whipsaws. And in return, you're also going to get a better return because when you catch that trend, you're going to stick with that trend instead of having a couple of whipsaw trades in the meantime. So we can see with SPY that if you're buying and selling across above the 200-day, either the close or the 5-day crossing above the 200-day, you get a nice positive expectation, and that's what we want to see for a trend following strategy. But if we do that with the 50-day moving average and say we buy on every cross above the 50-day and sell on a cross below the 50-day, well, you can see the results are not very good. You had a 2.88% compound annual return. You had a drawdown of 34% maximum, and you had 34% winners and 66% losers. But you can see that return is, you wouldn't follow a system that gave you a 2.88% return. And if we look at the signals, we can see just a whole bunch of whipsaws. So, you go below, and the red arrow is actually the day after the crossover. It shows when the sell signal is. And the green arrow is the day after the crossover. It's the buy signal. But look at all these whipsaws. You had basically 8 trades right there in that September-October period. And then we got a good trade here in November, another whipsaw there. And if we scroll back and we look at this period in 2019, some more whipsaws, pretty good signal, but then it gave it all back, and some more whipsaws. So you're going to get a lot of whipsaws if you're buying on a cross above the 50 and selling on a cross below the 50. And this is going to go for stocks and ETFs, the sector SPDRs as well. So since I ran the test with the 200-day using the 5-day moving average instead of the close above and below the 200-day to smooth it out a little, I'll do that with the 50-day. What if we bought when the 5-day moving average crosses above the 50-day moving average and sell when the 5-day crosses below? What would that look like? And you can see here the return did improve, but it's at 4%. And you can see the maximum drawdown at 28%. 45% winners and 55% losers. But basically the takeaway here is that you can see buying on a cross above the 50-day and selling on a cross below the 50-day is not the trade here, because you might as well just buy on the cross above the 200-day and just sit back instead of waiting for those 50-day signals. And that is because the 50-day is better used to identify mean reversion opportunities. And I'll go ahead and show these trades so you can see some of the whipsaws that disappeared. We'll see the actual trade. So you can see we had some reduced whipsaws here. We only had, 4 signals here instead of a dozen or so. And then if you go back to 2019, we still had some whipsaws, but not as many by just smoothing with a 5-day. But still, the 5-day crossing above and below the 50-day was not a good system. So here's a sharp chart of SPY over the past 11 months or so. And there we can see, the break below the 50-day, but that created the opportunity, not the threat. If you're talking about the break below 50-day being bearish, that is creating noise and not paying attention to the bigger picture or the bigger uptrend. Here we have another break below the 50-day, but it is not a bearish event. You can see that RSI moved into the oversold zone both times, and CCI, which is a little more sensitive sometimes than RSI, moved below minus 100 both times. And when CCI moves out of that minus 100 area, that's an opportunity for a bounce. Same with RSI moving back above 50 here. And so if we look here, we had this close below the 50-day moving average. And if that's your headline, the S&P 500 closes below its 50-day, well, that is missing the point, because the close below the 50-day was an opportunity that gave way to a bounce to new highs. So my suggestion is, when you're looking at the charts and you see a close below the 20-day or the 50-day and you're above a rising 200-day moving average, treat that as an opportunity to look for a bounce and look at that chart for some sort of bullish reversal pattern in the works. So here's the finance SPDR, kind of putting that example to work here. You can see you have this decline here to the 50-day. You had 2 closes below the rising 50-day, but you're above the rising 200-day. And so this was a setup, a bullish setup, a mean reversion opportunity, because you had a bigger uptrend and you pull back within that uptrend. And you can see RSI moved into that 30 to 50 zone, and CCI just touched below minus 100 to become oversold. So when you're below the 50-day and CCI is below minus 100 or RSI is in that oversold zone, that tells you that there's been a pullback, and that could be an opportunity. And so finance has already taken off and gotten to a new high. So the setup in finance is gone. You've had a big move, but there are other setups in, say, XLK and XLY right now. So here is XLY, and we can see there's the rising 200-day, and we had a close below the 50-day, I believe, yesterday, and we got a couple of intraday reversals working here, and you can see RSI's in that oversold zone, and CCI is now coming out of that minus 100 area. It was below minus 100, so that's when you're oversold, kind of like we were in September and November. Less so, because you can see the dip has been shallower. So this one could be ready for a bounce. And then if we look at XLK, we can see a similar pattern emerging. We've got the RSI below 50 in that oversold zone. We got CCI just going below minus 100. We didn't close below the 50-day though. So we're firming at the 50-day and could be ripe for a bounce to new highs. So over at trendinvestorpro.com, I put the sector breadth models to the test, and I tested them against a simple trend following technique. And it turns out that the simple trend following technique was a better indicator as far as taking signals. I was using a 3-indicator breadth model, then I used a 5-indicator breadth model, and then I timed it with some market timing, making sure the S&P 500 was in an uptrend. So if we look at average performance for the 3-indicator model for the 10 sectors going back 20 years, except for XLRE, which didn't start trading until 2015, not very impressive. Compound annual return of 4.36%, profit factor of 2.82. And basically what my research showed that you really need to focus on 5 key sectors, and XLC is a relatively new sector, but the other 5 sectors you don't even need to worry about when it comes to breadth models and broad market timing. If you focus on 5, you can get a pretty good performance, and using a trend filter for the S&P 500. But anyhow, this is a very long report with details in it that is available to subscribers at trendinvestorpro.com. Now, one more I want to highlight is ITB, the home construction iShare. Has been on this for a little while. It's kind of a boring one, but boring is okay for part of the portfolio. But we have this consolidation and a breakout, and then a little pullback, and then we got this little pullback working here. And it looks a little bit like a flag, if you will, and it's holding above the 50-day. And RSI is just near that 50 line, which is on the edge of mild oversold conditions. Not really oversold, it's just a pullback within an uptrend. CCI is not oversold, but this one is firming, and I would watch for a little breakout there and a continuation of the uptrend. All right, so that concludes this video on our YouTube channel. Please check out trendinvestorpro.com if you'd like to know more about our services, or you can follow me on Twitter at Arthur Hill. If you like this video, please give us a thumbs up and consider subscribing. Again, thanks for stopping by, and have a great day.